As of the close of regular market trading on Tuesday, August 4th, 2026, the market is currently closed and Tesla stock finished the session standing at $327.35 per share, reflecting an intraday gain of 1.64% or $5.27 after bouncing off an intraday low of $320.79 and touching a high of $329.57. When most retail investors pull up Tesla stock on their favorite mobile app, whether that is Robinhood stock trading, the SoFi trading platform, or an individual brokerage account at Fidelity Investments, they focus almost entirely on headline delivery numbers or high-profile public demonstrations. But if you sit down and inspect what institutional money managers are actually watching across platforms like Interactive Brokers Trading, the reality looks completely different. The real force moving this ticker right now is not whether quarterly vehicle deliveries beat or miss by a few thousand units. It is the widening gap between expected software margin expansion and actual hardware profitability decay. The widespread public narrative surrounding Tesla stock suggests that the company is either a pure high-margin technology pioneer about to turn on infinite high-margin cash flow through autonomous driving, or just another auto manufacturer bound to be dragged down by standard automotive valuation multiples. But the deeper reality is far more complex. Tesla stock is caught in a structural transition where its legacy cash engine, electric vehicle manufacturing, is facing real margin compression from aggressive industry discounting, while its future engines, full self-driving subscriptions, energy storage systems, and humanoid robotics require massive ongoing capital expenditure before they can fully replace those lost auto margins. Over the last several weeks of trading through July and early August of 2026, Tesla stock has experienced notable volatility. After climbing toward the high 400s earlier in the year, the equity pulled back sharp into the low 300s, briefly dipping down to a 52-week low of $297.38 before stabilizing near its current price level. This pullback was not an isolated event. It coincided with broader shifts across the technology sector, where megacap names like Nvidia stock and Apple stock faced heightened scrutiny regarding valuation multiples and return on capital investments. Looking closely at recent trading volumes, institutional participation has shown clear signs of repositioning. On high-volume trading days where over 50 million shares changed hands, significant order flow was directed through institutional platforms like the Interactive Brokers platform and Fidelity Brokerage Wealth Management accounts. Large asset managers appear to be rebalancing their portfolios, treating price dips into the low 300s range as accumulation zones, while capping upside rallies near resistance levels around $380 to $400. For individual investors engaging in self-investing or seeking investment help through platforms like Schwab Intelligent Portfolios or SoFi Invest, navigating this price movement requires separating headline noise from underlying capital flows. When retail traders place market orders through the Robinhood app to grab Robinhood fractional shares or buy whole equities on investing sites, they often react to immediate news headlines. However, institutional wealth managers using Fidelity Iris or dedicated Interactive Brokers account tools are evaluating long-term free cash flow generation and operating margins. To understand why Tesla stock moves the way it does, it helps to step back and examine the underlying business structure. Tesla operates across three primary business lines: automotive sales and leasing, energy generation and storage, and services. The core automotive segment historically generated the vast majority of total revenue, powered by popular electric vehicle models produced across gigafactories in North America, Europe, and Asia. Over time, the company built a competitive advantage around proprietary manufacturing techniques, direct-to-consumer sales, and an extensive global supercharging network. However, as traditional automakers and international competitors scaled up their own electric fleets, pricing pressure increased. To maintain market share and unit volume growth, pricing adjustments were made to major markets. While this strategy preserved total delivery numbers, it reduced auto gross margins from historical peaks above 25% down toward mid-teen levels. This gross margin compression directly impacted operating income, forcing investors to reevaluate what multiple they were willing to pay for every dollar of earnings. At the same time, the energy storage division, centered on large-scale utility batteries like the Megapack, has quietly scaled into a substantial revenue driver with higher margin potential. Utility companies and grid operators across the world are increasing battery capacity to balance renewable power grids, creating steady demand for energy hardware. Yet while energy storage is expanding rapidly, its absolute cash generation is still smaller than the automotive segment, meaning auto pricing dynamics still dictate short-term earnings reports. Software monetization remains the central element of the valuation debate. The promise of recurring revenue from autonomous driving technology and robotaxi networks is what separates Tesla stock from conventional auto companies in the eyes of growth investors. When people invest online through an intelligent portfolio or active trading platform like SoFi Active Investing or Fidelity Mutual Funds, they are often paying a premium for that long-term software option. If full self-driving achieves widespread unsupervised regulatory approval, it could transform vehicle hardware into high-margin platform nodes. But until regulatory hurdles are cleared and safety data is universally verified, that software potential remains an option rather than a fully realized baseline earnings figure. Recent macroeconomic conditions have added further complexity to this setup. Elevated interest rates over recent periods increased financing costs for car buyers, directly affecting consumer affordability and monthly payment calculations. When auto loans become more expensive, buyers either demand lower purchase prices or defer major purchases entirely. This macro pressure forced many investors using online investment platforms to reconsider their exposure to consumer discretionary equities, driving rotation into defensive assets or fixed income products like Fidelity ETFs. Despite these near-term headwinds, Tesla maintains a strong balance sheet compared to traditional automakers, holding substantial cash reserves and minimal long-term debt burden. This financial buffer gives the organization flexibility to continue funding heavy capital expenditures in artificial intelligence compute clusters, factory expansion, and product development, even during cyclical downturns in consumer spending. Looking forward, several key catalysts will determine whether Tesla stock can reclaim its previous high watermarks or remain range-bound between $300 and $400. The first catalyst is the launch and production ramp of next-generation lower-cost vehicle platforms designed to capture broader mass-market demand. If production costs can be kept low enough to protect gross margins at lower retail price points, unit volume growth could accelerate without damaging overall corporate profitability. The second major catalyst revolves around software advancement and regulatory milestones for autonomous transport networks. Progress in neural network training and real-world miles logged will be watched closely by institutional desks using interactive brokers' stock trading tools and corporate research desks. Any definitive regulatory approvals or commercial fleet rollouts would likely prompt significant analyst price target revisions across major investment banks. Conversely, clear risks remain on the horizon. Intensifying competition from domestic automakers in overseas markets, particularly in China, presents ongoing pricing challenges. Additionally, potential supply chain disruptions, fluctuations in raw material costs for battery production, and shifts in government subsidy policies could all create friction for margin expansion over the coming quarters. Before we move into our final breakdown of what all of this means for your portfolio, take a second and participate in the discussion. Comment below how many shares of Tesla stock you currently hold in your portfolio and what price target you expect it to hit by the end of this year. Evaluating an asset like Tesla stock requires balancing immediate market reality against long-term expectations. The market narrative often flips between extreme optimism about future tech projects and deep pessimism during auto margin pullbacks. The reality, as demonstrated by current trading around $327.35, is that Tesla is an evolving enterprise navigating a multi-year transition. Its core hardware business is absorbing competitive pressure while funding high-risk, high-reward initiatives in software, energy, and robotics. Whether you execute trades through Robinhood app cash management, build long-term positions through Schwab Intelligent Portfolios, manage an active individual brokerage account on SoFi, or utilize Fidelity Wealth Management services, maintaining clear risk management is essential. Investors who buy strictly into hype often panic when vehicle margins dip, while those who look strictly at legacy auto metrics miss the structural growth happening in energy storage and software development. Ultimately, understanding the tension